or insurance in general. And the first part of our series, we looked at how insurance helps us mitigate against loss of income. We followed it with how insurance helps us mitigate loss of health. And thirdly, we looked at how insurance helps us mitigate loss of life. Today, we want to look at the third part of it, which is actually the insurance products that help us achieve the mitigation that we've been talking about. I want to introduce myself again for the sake of those who were not there in the last 3 series. My name is Ayuna Thinwa, and I'm an insurance professional, very passionate about demystifying insurance and making it easy to understand and easy to access by all our people. And without a lot of time or taking a lot of time, allow me to share my screen so that we can follow it together. And we see the kind of products that we have, products that are available to help us achieve the objectives or the 3 perspectives of insurance that we looked at in the last 3 sessions. Just allow me to do that. Yeah. As part of our introduction, what I want us to bring out today is that the reason why we are pursuing this is to enable our people get equipped and to be able to identify right insurance products to suit or to respond to their needs. Insurance, like any other product or service, is supposed to respond or to minister to a particular need of an individual or an organization. And we will look at a few of them in terms of the life products first, and then we look at the general insurance products. Under the life insurance, we have endowment policies. Endowment policies are insurance plans which are arranged to coincide with the periodic medium and that is medium and sometimes long-term financial needs or financial commitments of a person. They are taken to respond to a particular need, or they are taken for a particular purpose. For example, we just look at a few, but of course the needs are not limited to what we have listed. For example, you could be planning to purchase a home for your family in the next 5 or 10 years, and you know you will need a financial deposit to help you achieve this. And what you can do or how you can use an endowment policy is that you can take an endowment policy whose maturity coincides with the time that you think or you plan to purchase or to undertake the purchase of a home. And that will help you raise the deposit. It could be an alternative or another need. For example, you want to create an education plan for your children. Your family is young. All children, none of them have started school, and you would want, when they start going to school or when they reach a certain stage, for example, high school, when education becomes quite a challenge for most parents because it is expensive, either high school or college. You can take an endowment policy whose maturity value or maturity date coincides with when your child will be going to high school. You could even take an education policy specifically configured or arranged to take care of the education needs of your child. And what happens is that that policy can either, or the proceeds of the policy can either be paid to you in one lump sum, or they are paid on an annual basis as the school fees fall due. They can also be paid termly. You choose this at the point of selecting the product. You could also plan to take your family for a holiday, maybe in the next 5 or 8 years, and you take an endowment policy on your life, which actually matures, or whose maturity date corresponds with the time when you want to take your family for a holiday, or even to take a holiday yourself. So it is not specifically just for an individual who wants to take a family for a holiday. You could even take it for your own holiday as a single person. You can also take you could also take an endowment policy and take it on the life of your child as a gift to your child. And the reason or the logic behind doing this is to reward or award your child, maybe for doing or performing well, and you would want to strengthen their wings to fly in future. And therefore, you look at a situation, for example, when this child would want to advance their education, you as a parent, probably you may not be working, could be you will have retired, or you could have other pressing financial commitments. For example, you could be constructing your retirement home, and therefore all your effort and financial earnings or financial commitment are directed or channeled towards that project. And therefore, even if your child wants to advance their education, you might find it a little bit hard to finance this. So if you take a policy in the life of that child, you will enable them. When that time comes, they will be able to get the policy proceeds and utilize them to advance or to undertake advancement in their education. And you will have done that. The best thing about this is, for example, you could be 45 or even 50 years old yourself, but your child is 18 or 19 years. So the policy will be configured around the age of that child, because you will take it in the life of that child. She will be the policy owner, and all you will do is that you will become the premium financier. You will be financing the premium. The other good thing or the other advantage about this, when a child is at their 19 or 18 years, they are just joining university, and therefore they have not started earning a living. And maybe in another 6 or so years, they will start earning. They could take over the payment of premium to that policy, because it is their policy, and when it matures, it will give them, it will be mature into their favor. This fund could also be utilized to help a child when they are settling in life. For example, they may want to take up a home mortgage for themselves. And just the way as an individual you needed to raise deposit for your home, even that child will need to raise a deposit. So you'll be giving them a springboard on which they can step and make it a little easier. And I'm sure they will appreciate, and you will be remembered a lot with appreciation by them. You could also take an endowment policy specifically to boost your retirement plan. If, for example, you want to retire at age 50 and you are at age 35, you can take an endowment policy for 25 years, and this policy will mature actually when you are 60, and it will help you supplement your retirement kitty. And at that point, you'll be able to supplement or complement your retirement earnings. You could also take an endowment fund so that on its maturity, it will help you create an emergency fund for your family. A fund that you invest, for example, in the money market, but as and when you need or you encounter emergencies, you can fall back onto that policy or onto that fund, which you will have created with the endowment policy proceeds. The last 3 sessions, we looked at how the endowment policy works. And we actually took an example of 3 lives, 3 individuals with a difference of 10 years among them. A 1977 born who is 45 years old, 1987 whose age next birthday is 35, and 1997 whose age next birthday is 25. And we said they both want to take a 10-year policy or an endowment policy that will mature after 10 years. This policy for the 45-year-old, it will mature when he is 55 years, and therefore he will be 5 years to retirement. The 35-year-old, the policy will mature when he is 45, and he will be 15 years to retirement age. We are assuming the retirement age that we are looking at is age 60 for the 3 of them. Age 25, the policy will mature when this person is 35, and he will also have about 25 years to retirement. So on the far end, the last 3 columns, or the last 2 columns, we have the estimated maturity value for the first policy, 658,755. When you compound it at 8%, you get 967,927. This is the fund this is the money that will be available in addition to the retirement kitty of this person. So assuming the retirement kitty was 10 million, he will be able to boost it with another 967,927. Same with the next, the person who is 35, he will, when he gets his policy proceeds at 45, he will be able to invest those funds at a compound interest rate. That is, he will be able to invest the 674,799, which will give him a fund of 2.1 million. This is the amount that he will be available to him if he wants to supplement his retirement earnings. He will be able to supplement it by this amount. And this also happens to the person who is 35. After investing this 677,650 for 25 years, he will have a fund, he will have a fund of 4.6 million. This fund can be used to complement, it will be available as a lump sum, and it can be used to complement his retirement earnings. The other thing that we need to re-emphasize here is the younger you are, the higher the advantage, because all life policies are dependent on age. The maturity value is dependent on age. You can see the person who is young has the highest maturity value for the same amount of premium. We are talking about 5,000 monthly premium. The person who is 35 follows, and the person who is 45 has the lowest because he started investing when his age was advanced, or he took the policy at an advanced age. So what I am emphasizing here is if you have the benefit of hearing me today, please consider taking up an insurance policy because the younger you are, the better. And we also said when you are young, there is the advantage of being healthy. The policy, an insurance policy is very much dependent on your age next to birthday and the status of your health. A young person is usually healthy unless something drastic or something unfortunate has happened. Naturally, a young person is supposed to be healthy and energetic. So your premium, when you say you want to pay 5,000 monthly premium, you will just pay 5,000 monthly premium because it will not be loaded. Your life is a standard life. So there is the advantage and the benefit of taking an insurance policy as early as you can possibly can. And we said the best thing is to factor in the need to take an insurance policy from the moment you start drawing an income. And by drawing an income, we said it does not have to be an income from a structured employment. It can be an income from even casual employments that you get, the wages that you are paid. The moment, and we said in one of the sessions, what is temporary is only the job. The earnings or the income is not temporary. When it is paid to you, it is your money and you can plan and invest. That is endowment policies. They could be anticipated endowment policies which provide for partial payouts during the policy term, or it could be a policy that pays a lump sum at the end of the policy term. If you are a business person, or if you are a person working in the informal sector, you may prefer to have an anticipated endowment so that at any given, after a specific period, you are paid a certain percentage of your benefit. And that will help you, for example, boost your business. It will help you start saving early for your retirement. It will help you in many ways, even setting up funds, the fund that we were talking about. You can set up an emergency fund that you build over time. When partial payouts are paid to you, or when you get advance payments from your policy, you are able to invest. I also want to look at term assurance policies. Term assurance policies are fairly cheap policies, and they are purely for protection. One thing that we need to mention about endowment policies is that they have got both protection and investment parameters. But the term assurance policy is a pure risk policy. It is usually taken with a long-term protection view of an individual's interests. Long-term protection commitments, for example, could be the mortgage loan. You could take mortgage to finance your family home. Mortgage loans are usually in the range of 10 to 20 or 25 years. During that period when you have taken the loan, you are expected to repay that loan to the financier, but anything can happen to you during the term or the mortgage term. And therefore, if, for example, anything happens and it affects your earning capacity or it cuts short your life, what happens is that there will be an outstanding loan, which will be a debt that you ought to have cleared, but because of the circumstances or the circumstances that have developed or cropped up, you are not in a position to process that loan. And therefore, what happens is that the financier would still need to have the loan repaid. If you have taken a mortgage protection policy to cover your outstanding loan, what will happen is that the insurance company will settle the outstanding loan and your property will be free of the charge that the financier had imposed on the property. And therefore your family will be able to get the title to the home or to the house and without any further payment. And it is a good thing and it is quite a relief. And you'll note that when that happens, the surviving partner or the surviving spouse will be able to continue with life with fair amount of comfort without the disturbing question of whether they will be able to afford rent or whether they will be able to afford the monthly mortgage loan repayments. It can also be taken by a financier. This loan, this term assurance policy, we have cooperative societies that are in the business of lending money to members. So what would happen is that the financier is well aware that anything can happen to a borrower during the period. For example, if you borrow a loan for 3 years or even 6 years, most of them are 3-year loan terms, and anything could happen. So what happens is that if the financier has taken short-term assurance loans to cover the liability or to cover the debt, in the event of death of the borrower, the insurance company, the financier lodges the claim with the insurance company, and the outstanding loan is paid. And therefore, the financier will not have the inconvenience or the uncomfortable situation where he has to go to the family of the borrower to demand the outstanding loan. It could also be taken to finance or to hedge against continuity of life for a surviving spouse. This usually will be suitable where the age difference between the spouses is very significant. You could have even a 60-year-old he's married to a 40-year-old. There is a big gap in terms of age between the two people. Meaning, if the older spouse were to pass on, the younger spouse will live for a very long time on their own. And they could be having young children that they need to take care of, or business interests or family business interests that they need to take care of. And even their own lives would still need to continue. And because the older spouse is concerned about the situation of the younger spouse, he can take a policy that will pay. This, when it comes to spouses, they could also take a joint term assurance policy. Joint term assurance policy pays on the first death, so that whoever passes on first does not leave the other one in a very challenged economic situation. So it can be arranged to pay on the first death. Circumstances could also require that it is paid on the last surviving spouse, depending on the circumstances and the need or the interest that they are taking care of. For example, you could have a family that it is financially able to take care of their young children, but in the event that the two parents are not there, the children will heavily get exposed. So what they do is that they can take a joint life policy, which pays on death of the last survivor. And that will now ensure that when the children are living without both parents, their needs will still be taken care of. So that is why we said it is important to assess your needs, so that when you take an insurance policy, you take a policy that nicely responds to your needs, or adequately responds to your needs. You could also have term assurance policy taken to cover business interests between partners, and especially when a partner passes on. This kind of insurance is, although it is a term assurance policy, it is named key man. You take it to insure the key person. The person who, if he passes on, will adversely expose the business. He could be, or she could be the key partner to the business. And without him, the business really gets affected. And therefore, when this person passes on, and if the business is to continue, there will have to be need to recruit or to train somebody else who can take up the position of the deceased spouse. And therefore, the term assurance proceeds that are earned will help in facilitating that. And it will also ensure that the business does not become adversely affected or inconvenienced. That is term assurance policy. There is one new policy that I want us to look at. This is cancer insurance policy. It is a fairly new policy launched by ICA Lion Life about 2 years ago. It pays a promised benefit on first diagnosis of invasive cancer or a benign brain tumor. Eligibility to this policy, it is available on anybody who is 18 or between 18 and 59 years of age can apply for this insurance cover. On diagnosis with stage 4 cancer, premium is waived. By waiving premium, it means the benefit, the company starts paying the benefit and no more premium is paid, because the assumption is stage 4 cancer puts the premium, the policyholder in a situation where probably he is not even able to pursue his normal income earning activities, and therefore he or she is grounded, and therefore he may not be in a position to continue paying premium, and that is why the premium is waived. And one may ask, if the premium is waived, then how does the company pay the benefit? The waiver of premium is costed in the premium. Whatever it is that you have paid, just the way you have the sum assured costed, also waiver of premium is costed and it is factored in, and it means that is a benefit that is purchased upfront when you are taking up this policy. No medical tests are required up to 5 million Kenya shillings, but should the company deem it necessary, it can request the policyholder to submit, even if the sum assured is below 5 million. So this is a grace window that the company provides just to make it easier for the policyholder. And we also know medical tests can also be quite tedious. This insurance is renewable annually, so terms can be reviewed depending on what has transpired around the life during the policy period, that is the 12 months period. The minimum term for this policy is 5 years, and the maximum age where you can enjoy this cover is up to your 65th birthday. So below 60, at age 60, you can only take the policy for a 5 years term up to age 65. For the lives of people who are below 60, you take 65 minus your age. That is the term of the policy that you can be covered. But remember, this is a short-term policy because it is renewable on an annual basis. That is what we have on the life products. But on the general products, these are general products, are policies that take care of the insured, or they take care of the non-life aspect of a person. In other words, they cover what the person owns. General insurance products are meant to take care of what you own. For example, if you own a home, if you own assets, if you own animals, you can take insurance cover to cover those aspects. And we will just look at them, a few of them broadly. For example, we have got personal accident insurance cover. This is a cover that is available for individuals or group to cover the expenses that arise from an accident to the insured. For example, you could get involved in an accident and you have to be hospitalized. There are medical expenses. You could need other aids, for example, wheelchair and other equipment, hearing aids and all that. Equipment that will meant to support you especially immediately after having an accident. The PA cover also helps the individual and family to avoid a situation where they have to take bank loans or even resorting to informal structures like Shylocks in order to raise deposits required to admit a person to a hospital. The product provides a lump sum benefit, or the policy provides a lump sum benefit on death arising from accident. It also provides a last expense or a proceeds or a value, a benefit that is paid to help in interment of the deceased insured. It also helps in dealing with hospital bills that are incurred after the accident. And of course, all these are limited to certain amounts per policy terms and conditions. So when you propose to take up a personal accident cover, you'll be able to see how much of this are you entitled to. And of course, the level of benefit will also determine the amount of premium that you pay. You can also have it as a family. We call it the family personal accident policy. The benefit of this is that, for example, when you have one family member involved in an accident and he is admitted in hospital, maybe the hospital bills are above the limit that he is entitled to under the policy. This policy allows a pooling of medical bills from other policy from other family members, sorry, not policy members, from other family members. This is an annual cover, but it is also good to mention that when people pool to take care of the injured, the family members who have contributed their portion of the entitlement actually stay uncovered until the following year. For example, if there is a hospital bill limit of 250,000 and you are 3 members in a family, and maybe the hospital bill is for this particular person who has been injured is 1 million, for example. You see that his own 250,000 will not be enough. But if you were a family of 3 members, if you were 3 members, you already have a total of 750,000, and the other 2 who have not been involved in the accident can contribute their portion. That is a total of 500,000 to help in easing the medical bill for the injured person. And of course, now you see, you will be able to offset 750,000, and probably this person had a national hospital covered under the National Hospital Insurance Fund. It also contributes, and you can see it would be possible to take care of his hospitalization when you pool and also factor in the NHIF contribution. Like I said earlier, the contract is annual and it is renewable. When it gets renewed, the members who had sacrificed or who had contributed their portion of the bill are actually reinstated, and everybody gets covered for the full benefit. So, and of course, it covers you for a period of 12 months. We have other general insurance products, which include the motor, which we are very conversant with, which covers both private and commercial, against comprehensive It could be comprehensive or third-party liability and property damage. We also have home insurance policies, which cover both building and content against fire and flood damage. The policy could also cover domestic workers on death or injury in the currency of employment. This is only for the liability that, or the injury that the homeowner is required to pay. We also have accidental damage or loss, that is, or injury that the insured is liable to pay as damages arising in connection with the subject property as either an occupier or an owner. This is a damage that could affect third parties. For example, you could have somebody visit your premises, they are your guests, and they get injured. For example, they trip or they sleep on the floor and, for example, break their spine, fracture their spine, or injure their foot. All these are injuries that the homeowner or the occupier of the home actually is liable to pay to those who get in and they get injured in their premises. So the policy also covers such. But of course, when you get to the home insurance policy, the details of what is covered will be very, very clear so that it does not leave any doubt. We have BISBORA, which provides cover to small businesses, and it gives them insurance, that is 7 insurance covers or non-motor covers in one single policy. And it covers the non-residential risks of business across the business spectrum. For example, it could cover the premises where the business is housed. It will also cover work injury benefits for the employees. It will also cover any liabilities that the business incurs to third parties. For example, people who visit that shop, that business premises, anything could happen to them when they are in that premises, and the insurance policy will take care of that. But you have to ensure that this is well captured. We have travel insurance, which covers, for example, loss of passport. It could also provide legal assistance if you need to. It could cover the insured against if they happen to get mugged, or if they happen to get hijacked, or if they miss a departure flight. The inconvenience that goes with that should be taken care of under a travel insurance. So like we said again, it is important to get the right solution for your needs to enjoy your peace of mind as you go through the journey of life. And you can see that these needs cut across yourself as a person, your liability to other parties, and also your own assets. And I think with that, if we can ensure that we buy the right policies to respond to specific and correct needs, we would not have a policy, for example, lapsing, so that you don't think and change your mind in the after you have taken up a policy. When you discover, for example, the policy does not take care of your needs. It is important for before uptake of a policy, you ensure that your needs are brought out clearly so that whoever is selling the policy to you should actually do a proper explanation as to what aspects the policy covers, so that you pick the correct product, so that you allow it to run up to the end, and you also reap the benefit of the premium that you pay. And of course, you enjoy the peace of mind that goes with the insurance. That should form the end of this presentation. And like we had put it again, you can respond to us by emailing us. If you click this icon, you'll be able to do an email to Holistic Insurance Solution. If you open this, you'll be able to, for example, if you click the middle button, you'll be able to open a form which helps you put in your personal details, your email. You also put your telephone number, and you will also tell us when you are available, date and time, so that we can contact you. And you will also be able to tell us, for example, what aspects of your question or your need to be addressed. And I think with that, we should, I'll just close the meeting.